Today, stock investors find it hard to shape market sentiment. On the one hand, they express fears about inflation acceleration and the likelihood of high interest rates for longer than expected. On the other hand, upbeat corporate reports promise strong corporate performance. At the same time, the prospects of some leading stocks are not as optimistic as wanted. The European Commission said that the European Union economy entered the 2024 year under weaker conditions than expected. Economic growth in the Eurozone was flat in the fourth quarter of 2023 from the previous quarter. GDP logged a 0.1% uptick from the same quarter in 2022, and last year the European Union economy avoided a technical recession. Still, economic prospects for the first quarter of 2023 are vaguer. More experts use the world recession in the light of a fresh macroeconomic data released in the world's developed economies. The report released today showed that Japan's GDP unexpectedly shrank by 0.1% sequentially in the final quarter of 2023. The economy contracted by 2.9% in the third quarter. Contraction in the economy for 2 quarters straight is the sign of a technical recession. Japan's nominal GDP was estimated at $4.2 trillion last year, and this figure for Germany surpassed $4.4 trillion. In other words, the top Eurozone's economy shifted Japan from its third place by a rank down. Before 2010, Japan's economy was second in terms of the GDP value until it was outpaced by China. The current fourth rank should deal a painful blow to the ambitions of Japan's authorities. Protracted weakness in the Japanese yen is to blame for downgrading Japan's economic rank. Japan's central bank is hesitating to tighten its ultra-loose monetary policy, awaiting the appropriate inflation rates and wage growth. And the Bank of England is in a more advantageous conditions nowadays, even though the British economy also slipped into a technical recession at the end of 2023 on the back of a decline in the 3 main economic sectors. The UK economy inched down by 0.1% in the final quarter, following a 0.3% drop in the previous quarter. At the same time, inflation was recorded weaker than expected, and consumer price grew by 4% from a year ago at the same pace as in December. The Bank of England and economists had projected inflation acceleration to 4.1%. In a separate survey, the UK reported robust growth in industrial production. Meanwhile, overall economic growth in the Eurozone's countries stayed flat segmentally in the final 3 months of 2023 and rose by 0.1% from the fourth quarter of 2022. European stocks rebounded following the data on the UK inflation, and from now on, roughly 72% investors anticipate the first rate cut by the Bank of England in June. As for future decisions on the key interest rate, ECB chief economist Philip Lane linked the timeline for rate cuts with the macroeconomic data. We are moving in the right direction in terms of fighting inflation, but it will take more time, the policymaker warned. He added that there are risks of cutting rates too soon or too late. ECB President Christine Lagarde said that it was too early to discuss monetary easing and that such a scenario could arise in the summer of this year. And just like yesterday, the global market reacts more strongly to statistics published in the United States. Data from the world's largest economy clearly carry much more weight. Even American reports are pursued differently. For example, a weekly update on initial unemployment claims did not excite the markets much. Moreover, they are in line with the expectations. So, They have been growing slightly, thereby cooling the labor market, and the focal point today is the data on the US retail sales. Though the region is sensitive to seasonal factors and to consumer prices, the latest slump looks appealing. US retail sales slipped by 0.8% in January from a month ago, much sharper than the consensus for a 0.1% downtick. It's the worst decline in retail sales since March last year, and the US industrial production also fell short of expectations. Instead of a 0.3% increase, the indicator edged down by 0.1% in January, following a flat reading in December. No wonder the United States dollar lost ground amid a decline in the industrial production rate and a sluggish consumer activity, which is seen as a catalyst for the US economic growth. Recently, the greenback was strongly overbought, and the euro-dollar pair was trading in a narrow range between 1.0725 and 1.0745 before the US economic data. Then the instrument went sharply up. Now we cannot expect a retracement to the former critical support level at 1.0700 today, and traders should monitor resistance at 1.0708, which the euro-dollar pair already tested in the early New York session. Moreover, the ECB's plans look more hawkish than the Federal Reserve's agenda. It means that the euro could make an attempt to climb to technical resistance at 1.0789, and crude oil is trading today under strong pressure. First, oil prices have the opposite correlation with the US dollar. Second, the main culprit of a fall in oil prices is the data on the US oil inventories that expanded by a whopping 12 million barrels last week, hence oil prices took a nosedive. Nevertheless, weakness in the US dollar mitigated a 3% plunge in oil prices, and the lower border of the intraday corridor briefly slipped below $80.80 a barrel. In terms of a technical analysis, traders could increase long positions after the price settles above $85. You have watched the market review by InstaForex analyst for Thursday, February 15. Subscribe to InstaForex TV channel, and we keep you updated on recent market developments. Don't miss our videos. Your feedback is appreciated, and see you online tomorrow.